Welcome, and thanks for joining and watching this quarter's investment and economic update. I'm Ross Bramwell, a member of the Hummerberg Investment Department, and I'll be taking you through this quarter's commentary. To start, I'm going to summarize the main points we'll discuss. The good news is that we have passed peak inflation and the disinflationary trend seems intact. However, we believe it is still too high for the Fed to think about cutting rates. At 3.2% inflation year over year, the Fed believes it has much more work to do. We believe the Fed is likely to remain aggressive, and even if the Fed decides to pause at current levels, we believe rates will be held here for longer than the markets are anticipating. Even if the market cheers a Fed pause in rates, we believe the recent banking crisis will have an impact over the next year as banks have tightened lending standards significantly, which is reducing the credit available to consumers and businesses. This will keep the economy in restrictive territory even if the Fed pauses. If you're watching economic headlines, there are many indicators that are broadly used to point to a recession. Almost all of them are flashing red currently, except for the job market, which has supported consumer spending. If it were not for jobs and consumer spending, we'd already be in a recession. We believe it may be difficult for inflation to move lower than the current 3% range until labor comes into more balance. In order to avoid a recession, the Fed would need to get inflation down, still without unemployment rising significantly. History indicates this may be hard to do. But so far, the job market remains strong enough, which is supporting consumer spending. We're now past peak inflation and pretty close to the end of the rate hiking cycle. However, the impact of these rate hikes is still working its way through the economy. So what we are watching closely is earnings, which are still expected to be just slightly positive for 2023. Markets are pricing in a sharp rebound in the second half of earnings in 2024, and we'll dive into this issue. So where does this leave us with portfolio positioning? Given high valuations and weakening economic indicators, we have positioned portfolios with an underweight position in both domestic and international equities, and an overweight exposure to high-quality short-term bonds and cash, given the yields that we can achieve. Earlier this month, Fitch downgraded the U.S. debt rating. To put the downgrade in context, Fitch had maintained the USA's AAA rating since at least 1994. This compares with Moody's, which still has the U.S. with a AAA rating, while S&P downgraded to AA+ in 2011. In 2011, however, S&P's downgrade was during a flight to safety by investors, as global markets were in more turmoil than today. Overall, the downgrade is a headline, but we believe will have little direct impact on the markets. What it did, though, was to highlight the future risk of rising interest costs and upcoming potential political gridlock and turmoil. U.S. Treasury Secretary Janet Yellen, she downplayed Fitch's decision, but it was also in a congressional testimony that she highlighted the risk of federal net interest costs reaching 3%. Currently, within the last month, they've been around 2.3%. But this was also one of Fitch's main concerns. We could possibly pass the 3% mark in under 6 months from now at our current rate of debt issuance and with rates over 5% on short-term bills. And with the Fed indicating at least one more rate hike and even longer dated Treasury yields increasing in recent weeks, these costs will only increase over the short term and medium term as rates continue to move higher. So the high cost of debt interest is something that Congress will have to step up to the plate and try to handle. The Fed and Treasury can only kick the can down the road so far before Congress normally steps in and kicks the can even further down the road. But if we look at the 2011 downgrade, this time is different. Yields are rising. In 2011, yields were declining. Although we talk about the Fed tightening and trying to slow down the economy, the fiscal side of the house has been doing the exact opposite. Government spending has increased this year and is coming off a short-term low if we look at it as a percentage of GDP, after COVID. On the right hand of the chart, the blue line that represents net interest, you can see a sharp spike. This is net interest cost as percentage of tax revenues. That's because at the same time that interest costs are rising, federal tax revenues are declining. So our net interest costs are becoming a greater percentage of the dollars that we're bringing in. This leaves two options. The government could rein in its spending, but we've learned over the last decade that both parties like to spend when in power, so that may be difficult. Or the Fed may need to look to cut rates just to help the Treasury given the fiscal deterioration that we see. Here's just another way to show the short-term increase in government spending as a part of GDP that we've seen this year. As the Fed continues to restrict monetary policy, the government's contribution to U.S. GDP has increased this year as the deficit grows. Due to the substantial growth in money supply during COVID, it appears that the COVID stimulus was monetized as the Fed bought a significant portion of the bonds issued by the Treasury. This increases the risk of sticky inflation and may be a headwind for the Fed in the near future. So you may have thought that the political crisis was over once the debt ceiling was passed earlier this summer. That is not the case. The recent debt ceiling deal tried to incentivize Congress to get a spending deal in place ahead of the election year. Congress has a deadline by the end of the year to reach a deal, either having the appropriation bills in place or a full-year temporary budget in place. If not, a 1% cut in spending will be mandated from 2023 levels. However, these cuts do not go into effect until April 30th, which gives Congress even more time to come up with a solution. It's very likely that Republicans will argue lower spending levels are needed to get the budget under control. Odds are rising that we could have a government shutdown come October 1st. We believe the market will begin to focus on this next month with the first September 30th deadline looming. Here we have a chart that shows the net liquidity in the system, the blue line, and it's overlaid with the 10-year Treasury yield, the yellow line, that's using the right-hand scale. When the first regional banks failed in March of this year, so right about here, the initial reaction was that the Fed would have to cut rates by July of this year, just this summer. But the bank crisis was pretty well contained through quick actions. The Fed did step in, as you can see, a rather significant bump in liquidity in the blue line in March of this year. That shows the increase in liquidity. But overall, between the Fed and Treasury's actions over the last year, liquidity has been draining consistently since the beginning of 2022. This decrease in liquidity has had a highly correlated effect on yields. We don't see this dynamic changing anytime soon, and liquidity is likely to have continued pressure on it given the Treasury's high debt issuance, tighter bank lending, and maybe even higher capital requirements for banks. This leads us to believe that yields could stay higher for longer than the market is currently anticipating. Here we show the yield curve at different points of time, starting with a year ago at the bottom in tan for August of last year, 2022. Of course, since last August, the Fed has pushed up short-term rates. Here you see in the gray line, which is of 3/31, black line is of June 30th, and the maroon as of this week, August 22nd, that the Fed has pushed up the short-term interest yield significantly with additional rate hikes. During this time, longer-term yields on the longer end of the curve have remained suppressed and only moved up gradually. However, as we've gotten closer to the end of the rate hiking cycle, we can see that from June 30th in black to the current yield curve in maroon, that the longer-term rates have actually moved up pretty significantly in recent weeks. This would be due to positive economic data, the increased supply of U.S. debt issuance, and fewer global buyers as global yields have also moved higher. There's more competition, there's more alternatives. This is only going to increase the cost of U.S. debt going forward. On this chart, I just want to focus on 2 points. First, if you follow the headline inflation reported over last year, there's been a steady and significant decline down to 3.2% in July. However, when you look at the bottom 4 categories, which we can refer to as core CPI, we've gone up through the first quarter of this year, and then we've gone down slightly through the summer. The Fed right now is more focused on core CPI, which are the stickier parts of inflation, including housing, services, travel, food, etc. Until the Fed sees a steady decline in this line, it is unlikely that the Fed will be comfortable in cutting rates. Core CPI was 4.7% last month, which is still significantly higher than the 2% target. And given the rise in energy prices this summer and wages that continue to move higher, there are some undercurrents which have increased the risk that inflation may just move sideways or even move slightly higher by year end. To dive a little deeper into inflation, I just want to point out the significant impact that housing costs have on inflation. As you see here in the chart, it has the largest percentage weighting or contribution to inflation. Now, there are a few different components of CPI housing costs that go into the calculation, including rents and also primary residences. It's also important to note that the math behind housing costs is very lagged, and that the Fed looks at pricing every 6 months and has a 12-month average of housing cost. So it takes a while for housing inflation to go up and for a while for it to come back down. It's not nearly as volatile as other components such as energy or travel or food, which are measured each month. So while it's clear that we are in a deflationary trend, which is what the Fed wants to see, the Fed is going to want to see this trend continue. Energy and other commodities have been a deflationary factor for inflation since the first quarter of this year. But given where transport and energy and several other commodity prices are right now, that may likely reverse sometime later this year. Many have argued that the Fed should have already paused because housing costs are so lagged and consequently skew the data. A chart of rents over the last month would show that housing rents are not going up nearly as much as the 12-month average in the CPI calculation. This chart supports the thesis in that if we remove housing costs from the aggregate calculation, that CPI ex shelter is already below the 2% target. I think it's also interesting to note that the CPI ex shelter almost reached 11% last summer, which was higher than the 9% peak in headline CPI. Now, of course, the Fed knows this too, so it's not a secret, but it does increase the risk that if inflation is already coming down to targeted levels, and if the Fed remains in a tightening mode, that the Fed could do what the Fed has historically done, and that is break something in the economy or walk it right into a recession. The economy has been resilient despite the Fed's desire to slow down the economy and bring down inflation. The economy has remained strong with good wage growth and a consumer that is still spending on services and travel and entertainment, as shown by the current estimate for US Q3 GDP of over 5%. But the Fed is not acting alone here, as we've discussed the role of government spending. Historically, there has not been just one wave of inflation. That is still a key risk for the markets. With several areas of inflation still sticky with elevated prices, the economy needs energy to evade a sharp increase in commodity prices and for housing costs to continue their decline over the next 6 to 8 months. Otherwise, with the continued deficit spending, we are not out of the woods yet in regards to another inflation wave, as we've seen here on the chart with prior historical periods. Historically, the Fed has not stopped a rate hiking cycle before its key rate has moved higher, often significantly higher than CPI. With the Fed funds rate now at 5.25% to 5.5% and inflation at 3.2%, this gives the Fed the option of skipping or even pausing on additional rate hikes. But we will still get another inflation report, another jobs report before the next Fed meeting. So although a pause is justified, we believe it's way too early to discuss any possibility of rate cuts in the near future. Remember, core CPI is still at 4.7%, so much closer to the Fed funds rate. One of the issues the Fed has had is that the markets have not believed its messaging and guidance. Fed members have consistently messaged that they expect to keep rates at peak levels through 2023 and now for most of 2024. However, after the banking crisis in March, markets were pricing in that the Fed would begin cutting rates this summer, and that the Fed would cut rates by 1% or more by January of next year. The markets have been cheering the possibility of a pause, with the expectations that a rate cut could quickly follow. Currently, the markets are pricing in a peak Fed funds rate in November, although it's still less than a 50% chance that's being priced in. But then the markets have the Fed cutting by next March of next year, right? We'll see the first rate cut here as we see the Fed funds rate dip, right? And then by next fall, we're sitting at below 4.5%. Right now, a lot of good news is priced into the market, including no additional rate cuts, no recession, a soft landing scenario, and rate cuts by next spring. A miss on any one of those expectations would likely mean a setback for the stock market. Here the chart shows a historic increase in money supply growth from the beginning of 2020 through to early 2021. The supply growth has significantly decreased over the last 18 months, however. You can now see that year over year money supply has been negative since the end of last year. I will also point out that the peak in money supply growth was at the same time of the last fiscal bill passed during the pandemic, but inflation did not peak until 4 months later in June of 2022. This shows the lag effect of monetary and fiscal policy. This leads me to two conclusions. First, the slowdown in money supply growth should continue to put downward pressure on inflation, which is good. The second is, however, not as positive in that the slowdown should also continue to weaken economic growth and put pressure on the jobs market. Taking into account our earlier discussion about government spending, you'll notice we hit a low point about 4 months ago, around the time of the bank failures occurred and the Fed provided additional lending to the system. We've also seen an increase in government spending and debt issuance. Month-over-month money supply growth has reversed to positive growth in recent months, which has been a support for the overall economy and the stock market, but it may not be as helpful to the Fed in getting inflation further down to 2%. The job market remains strong as shown in these charts. There are still more job openings than we have unemployed people. The economy is still adding jobs each month. We have seen a tick up recently in weekly unemployment claims, so we'll be watching that closely to see if the initial cracks in the job market are expanding. But overall, even though we may see cracks every so often in the jobs market, it has not cracked. As we see in the continued claims, people who are looking for jobs have been able to find one for the most part in a reasonable amount of times, as continuing claims have stayed fairly consistent or even trended lower recently. Strong job markets equals a strong consumer, which is the backbone of our economy and keeping us out of a recession. In last quarter's presentation, I had a similar chart to this one that shows bank tightening and job losses, which historically have been highly correlated. In this chart, you will see that a rise in the red dotted line, which represents an increase in bank tightening, has been followed by an increase in the blue line, which are the job losses for the previous three recessions, 2001, 2008, and 2020. However, this time has been different so far. From one of the research firms that we use, it's estimated that we need 171 million workers in the economy, but we only have 167 million workers. Now that 4 million gap in workers may not seem like a lot, but that may be the difference in getting services inflation down, which of course one of its largest components is wages. We either need more workers or we need productivity gains from technology or even AI, artificial intelligence, to make up the difference. And until we find that balance, it may be hard for the Fed to loosen up on rates because it may very well lead to another inflation wave. We look closely at the leading economic indicators to evaluate the prospects of a recession. We've now had 16 consecutive months of negative LEI readings. If you look at the left-hand chart, the gray bars represent prior recessions. Looking at the current decline in the LEIs, it certainly looks like we should be in a recession. But as shown in the bottom right chart, which lists the coincident economic indicators, we can see that the job market continues to hold up and is supporting consumers and the economy in the face of several strong economic headwinds. Coincident indicators try to represent real-time changes in the economy, and there's still a strong trend in the jobs market, whereas we can see weakening trends in most other areas of the economy. For the first half of the year, market returns have been highly concentrated in a few stocks, namely the largest 7 stocks in the S&P 500. This summer, as some of those large tech names have faltered, the rally has broadened out in a welcome sign by investors. The chart shows the return differential between the S&P 500 cap-weighted and equal-weighted indices. To have confidence in a soft landing scenario for the markets, we would like to see a broader rally where more stocks are participating in price appreciation, but also in the earnings growth that's expected to come later this year. This slide is looking at earnings data for the S&P 500, but is following the trend and expectations for earnings as time has passed. For example, the tan line on the bottom shows the expectations for 2023 earnings for the S&P 500 companies and how they've evolved over the last year. 1 year ago, analysts expected the S&P 500 to produce about $242 of earnings per share in 2023. But over the last year, this has slowly drifted down towards the current level of $219, almost $220, representing just about 1% growth over last year's earnings. The maroon line shows expectations for the S&P 500 earnings growth in 2024, next year. The maroon line in the chart shows the evolution of earnings expectations and how they've changed over the last year as well. As you can see, this line has also trended slightly low over time, but remains well above the tan line as the market is currently pricing in double-digit earnings growth in 2024. If a recession were to materialize later this year or early next year, we would expect these expectations for 2024 earnings to drift lower from these levels, and this would be a further headwind to returns in the months ahead. Markets are expecting an earnings rebound the second half of this year. Second quarter earnings have been better than feared since early July, when estimates called for a greater than 8% decline in earnings growth. And here we are in the second quarter of just down a little more than 3%. But the second quarter will mark the third consecutive negative year-over-year quarter for earnings growth. Markets are pricing in a quick rebound in the second half, led by the same 7 stocks that made up most of the return in the first half, as they have some of the largest expectations for improved earnings later this year. Stock returns over the last 12 months have been driven by multiple expansions or valuations, not earnings growth. Since last summer, earnings expectations, shown here in the maroon line, have actually declined, while multiples have risen more than twice of the actual stock market's return over the last 12 months. This is that the market, right? This is reminding us that the market is always forward looking, right? And then right now, currently, it's pricing in a lot of good news on the earnings front, similar to what we just looked at in the previous slide. On the chart on the right here, it is the same chart we just looked at that shows earnings growth in gray, which has been flat. And the other two lines are the S&P 500 return year to date and valuation growth. So we're just looking at year to date numbers. You can see that they are right on top of each other, which, as we've discussed, shows that all of the return this year has been from multiple expansions, people willing to pay higher valuations for the same amount of earnings. And at current levels of close to 20 times on forward earnings, whether you're looking at next 12 months or 2024 earnings, this would make us believe that stocks are currently expensive, which is part of the reason for the recent pullback that we've had. It's just an adjustment in valuations. Now let's take a look at valuations in the public equity market. Valuations help us get a gauge for how cheap or expensive stocks are. We look at a variety of metrics to measure valuation, but let's discuss a commonly used valuation metric called earnings yield. The earnings yield looks at the earnings generated from an investment and divides that amount by the price that is being paid for the investment. Simply put, the earnings yield is the earnings that are being generated for each dollar invested. A higher earnings yield indicates that investment is cheaper, while lower earnings yield indicates that investment is more expensive. This is particularly important valuation metric to monitor at this time because we can compare the earnings yield on the S&P 500 to the rapidly rising yields that can be generated on cash and bond investments in today's market. This chart looks at the earnings yield of the S&P 500 over the last 20 years. We can see that over time, the yield has averaged about 6.6%. It has been as high as 10% during the financial crisis and as low as 4% recently during the market run-up in 2021 during COVID. Today, the earnings yield on the S&P 500 is just above 5.5%. This is slightly lower than historical averages and is our view by no means cheap, given the current uncertain economic environment, and as we'll shortly see, the attractive yields that can be generated on lower risk investments. This chart is showing the exact same S&P 500 earnings yield chart, but now we're going to overlay with this the yield that can be generated on cash, as measured by the 3-month Treasury bill over time. If we had to choose one chart that explained the sell-off in equity markets in 2022, I think this would be on the short list. As you can see, during the sell-off in 2022, earnings equity yields rose modestly from that low near 4% to the current level around 5.5%. However, at the same time, the yields on cash and other high-quality fixed income investments rose much further. Over the last year, the yield that can be generated on cash has risen from essentially 0 to nearly 5.5%, matching the earnings yield on equity investments. We have not seen this environment or this dynamic since before the tech crash in 2000-2001. As you can imagine, this can be an attractive alternative to stocks. Before, we would say TINA, as in there is no alternative to stocks, but now people are saying TARA, as in there are reasonable alternatives to stocks. Taking a step back and thinking about the information that we have talked about so far, we believe that we are in an environment with an elevated risk of an economic slowdown, which could impact corporate earnings. At the same time, valuations on the equity market are not cheap, and the yield on short-term, high-quality fixed income instruments or investments is as attractive as it's been in 20 years. All of this has led us to take a cautious view on the stock market and to be slightly underweight stocks and portfolios, instead favoring an overweight position in short-term, high-quality bonds. We don't normally spend a lot of time discussing momentum and the technicals of the markets, but given the recent run-up we've seen in the markets, mainly due to higher valuations, I thought it'd be good to mix in a few comments. In the top chart, we show the S&P 500 in black, with the 200-day moving average in brown and the 50-day moving average in blue. The red markers identify corrections in the stock market since we've hit the lows last fall. As you can see, we've been down almost 20% and a couple more 8 to 10% earlier this year and late last year. The bottom chart shows the percentage of companies that are trading above its 50-day moving average. You can clearly see that in August and December of last year, the peaks were hit around 90%. Before there was a correction and the market started to pull back. That's an extremely high level and is not hit very often. The market declined shortly thereafter. Last September was almost a 20% decline as the Fed surprised the markets, or 20% decline in the S&P 500, as the Fed surprised the markets with a much tougher stance on inflation at its Jackson Hole meeting in last August. Earlier this year in January, we were close to 80%. Of the stocks being above the 50-day moving average. And then it led to a 9% market correction. Greater than 50% of stocks moving above the 50-day average is typically seen as a bullish indicator. But at extreme levels, it often means that stocks have gotten ahead of themselves. We can see just that this last month, we are right at 90% again, meaning sentiment was positive, but without an increase in earnings, it was really built just on higher valuations. And since that time, markets have begun to drift lower. However, with many of the largest stocks that had outperformed earlier this year, now down 5 to 10% from their highs, and valuation still on the expensive side, we would not be surprised if the stock market needs a little more time or a little bit more of a pullback during the seasonally weak period of August and September as it waits for the Fed's next move. Any surprise by the Fed, although unexpected at this point, could also lead to a larger reaction. To wrap up, the markets are highly anticipating when the Fed will pause and even begin rate cuts. These are important assumptions that investors use to price the overall market and individual stocks. However, historically, rate cuts have not been a positive for the stock market. U.S. stocks have done okay after a pause, on average up mid-single digits over 3 to 4 months. But after the first rate cut, the S&P has declined on average over 20% over the next 8 to 10 months. Historically, the market has not bottomed before a recession or before a rate cut. Here you can see that on the chart, showing the last few. Here's when the rates began to cut, but the tan line is showing when the market bottomed. Again, in 2007, 8, we began rate cuts, but the market didn't bottom until almost a year later. The Fed is typically cutting rates because economic conditions are weakening. So a pause and even a rate cut does not mean that we have achieved a soft landing. Now, we are certainly in unprecedented times when historical norms are not leading to the predicted outcomes. But until we have clarity on when the Fed will pause, and maybe more importantly, for how long it will stay at the peak levels, or until we see economic indicators bottom and actually move higher, the LEIs that we're watching, we are likely to stay more cautious in our outlook. Thanks again for joining us and taking the time to watch this presentation. If you have any further questions, please reach out to a member of your client service team. Thank you.